Most business owners think that tax season ends right after filing their tax return. But in reality, that might be where most of the tax mistakes really happen. Because the seven-figure entrepreneurs who save the most in taxes plan immediately after filing their tax return. And if you wait until April, well, you might already be too late. Welcome to Simplify My Numbers, the show for the 765 entrepreneur. Seven-figure revenue, six-figure take-home income, and five figures lost to taxes every year. If that sounds like you, you're in the right place. My name is Fabrice Matan. Each episode, we break down real tax planning strategies that help seven-figure business owners legally reduce taxes and keep more of what they earn. Let's stop guessing and start planning your taxes on purpose. Let the show begin. 7, 6, 5, 4, 3, 2, 1. The Simplify My Numbers podcast is for informational and educational purposes only. So, to a certain extent, April is not the end of tax season for wealthy entrepreneurs. It's essentially more of a scorecard. You already knew before the end of the year what your tax position might look like if you did proper planning as you went throughout the year. And so when we get to the tax return, essentially all we're doing is the compliance part, is checking everything, making sure that everything is labeled where it's supposed to be, checking all the boxes, entering all the numbers, and submitting the tax return to the tax agencies. At that point, you know exactly what you owe or what you're getting back, and you submit everything like you're supposed to. But that is when you understand now what happened last year, and based on that as your baseline, how do you plan for the current year? So your 2026 tax bill is actually being created right now. So there are 4 mistakes leading business owners to lose money after tax season. Mistake number 1 is waiting until year end. So there's several things that needs to be planned earlier in the year in order to make sure that you take advantage of the potential tax strategy and the potential tax savings. For example, entity classification. There's a reason why the deadline to submit an S-Corp election is March 15th. The IRS understands that at that time, you would have already, submitted the tax return, or you'll be close to submitting your personal tax return to see exactly how you're affected. And then you can then make the election for the rest of the year, for that entire year. Now, even though you do still qualify for a potential late filing election, it is still the original deadline for a reason. And so you have to know that fairly early in the year, have your estimates, know exactly what you're planning to do in the business in order to make a decision as to whether this is the right year to change your entity classification. Also, retirement contributions. It's not something that you want to decide at the very end of the year because the cash flow may not allow you to make as many contributions as you would like to make. And so by understanding that earlier in the year and being able to strategize gradually, you may be able to contribute towards those retirement accounts in smaller increments as opposed to waiting for a large chunk to happen before the end of the year. And also your estimated taxes, right? So at the end of the day, as a business owner, you are expected to make quarterly estimated tax payments. Now, those quarterly estimated tax payments generally can already be known based on what your tax liability was in the previous year, at least to avoid any penalties. But that number does not include or does not take into account how much revenue and how much profit you're actually making in the current year. And so to be more accurate, you do still need to have some estimates of what your revenue is going to be in this current year, and then plan to make some quarterly tax payments as you go throughout the year. Just to remind you, the quarterly tax payments dates are actually April 15th, June 15th, September 15th, and January 15th. So it doesn't necessarily fall right after each quarter, but those are the dates that you are supposed to keep on your calendar to know when you're supposed to make a quarterly estimated tax payment. And so you essentially want to be able to know your numbers, have some good estimates to be able to submit the payment that you need to as you go throughout the year. So it's not a huge amount that you have to catch up on before the end of the year. To put it simply, tax planning in December is damage control. I'm not saying that we don't do that for certain clients. We still get a lot of people that come in the last quarter of the year, but we would much rather work with people earlier in the year for better results. Mistake number 2 is never reviewing your entity structure. It happens all the time. Your business evolves faster than your structure. So you're not realizing exactly when you're supposed to switch from a single member LLC to an S Corp, or if your S Corp should instead be a C Corp, or if you need to have a partnership set up or sole proprietorship for some reasons. Essentially, all of these things need to be evaluated as you go throughout the year so that they can be effective for that current tax year. And why does your entity structure actually matter for your tax position? Is because entities are actually taxed differently. So if you think about it, every entity gets taxed differently, right? So sole proprietorships, single member LLCs, multi-member LLCs, and S Corps are pass-through entities. They do not pay taxes at the entity level. The owners of those entities pay taxes at their personal level, right? On their individual taxes. But when you have an LLC that you then convert to an S Corp, it changes your tax structure because you're now taxed on your wages in a different way than you are taxed on the net profit of the business, which is different from the single member LLC. Now, when you are C Corp, that C Corp is its own separate entity that pays its own taxes at a max of 21% at the federal level. So as you can see, every single one of those entities have a different tax structure. And so if you wanted to get a little bit more details on that, you would definitely want to subscribe to our channel so that you catch the very next episode where we do a deep dive on every single one of those entities. Mistake number 3, ignoring bookkeeping until next tax season. See, messy books equal expensive tax returns. Essentially, if you don't know what your numbers are, you're not able to take advantage or maximize all the deductions that you can actually take. You're not able to estimate exactly where you are so you can, plan for the tax liability that you might have. And you're not able to exactly determine if it's time to make a change in your entity. And so being able to allow yourself not to neglect your bookkeeping throughout the year is extremely important so that you know the numbers better and you're able to adjust as you go. And mistake number 4 is never looking back at prior returns. Yes, your tax return has been filed, but you have to know for sure that it has been optimized as well. So you always want to go back to the previous tax return, make sure that there was nothing that was missed, make sure that you get a professional review and know exactly where everything stands prior to deciding what needs to change in this current year. And so it's always good practice right after tax season to take a look at what was filed and start asking questions. Was I supposed to pay as much taxes as I did? Was I overpaying taxes throughout the year and essentially received too large of a refund? Because that's also another situation that you kind of want to avoid. Why would you essentially loan your money to the government that gets repaid to you with no interest, right? So the idea would be if you could be at a net zero, it's perfect. Some people might use it as a savings account, and I understand that as well. But half of the time, you could have that money to either grow your business or even invest it in the market to try to multiply, your returns. All right. So let's review those 4 mistakes. Mistake number 1, waiting until year end. Mistake number 2, never reviewing your entity structure. Mistake number 3, messy bookkeeping. And mistake number 4, never reviewing your prior tax returns. And so the entrepreneurs who make the most money are not always the ones who have the most revenue, but they're simply the ones who strategize and plan better. Right? They're being more proactive about understanding their numbers and treating taxes as a strategy as opposed to a once-a-year event. So as long as you are in that mindset of making sure that you have your tax planning, your tax strategy in order, that you don't treat tax season as the last time that you need to talk about taxes throughout the rest of the year. And I understand a lot of business owners, that's the last thing they want to hear about, right? No one wants to talk about taxes. No one wants to pay taxes. And so essentially you're thinking, why? Why should I even worry about it once we got my tax returns done? Well, the idea is simply to use it as part of your strategy inside your business so you can keep more of your hard-earned money. Thanks for listening to Simplify My Numbers. If you found value in today's episode, There are 3 things you can do to support the show. 1, subscribe so you never miss a strategy to protect your profits. 2, leave a review on Apple or Spotify. It helps us reach more founders just like you. And 3, share this episode with one fellow member of the 765 community, someone you know who's working hard but losing too much to tax inefficiency. Remember, your chaos is our comfort zone. We'll see you next time.
This show is part of the ICT Podcast Network. For more information, visit ictpod.net.